2021 should be a year of robust recovery. That is according to our next guest, Mark Skousen. He is editor-in-chief of Forecasts and Strategies, and he is also the professor and a presidential fellow at Chapman University. Mark is an accomplished author as well. Please go read his bio at markskousen.com. I can't live your whole life's achievements, Mark. It'll take me all day. markskousen.com. You'll learn more about him. Mark, welcome back to the show.
Glad to be back with you and to talk about this robust economy as we're going into 2021. I know Donald Trump doesn't want to hear it. Biden certainly will take full credit for it, but it does seem that we're headed in that direction as we continue 2021.
We're going to be talking about Biden's $2.2 trillion stimulus plan and how that would affect your outlook on the economy. But first, I'd like to get to the core of our discussion, which is gross output growing at a significant rate. Now, you sent me one of your articles you wrote recently. On March 25th, the BEA released the fourth quarter 2020 gross output measure. And according to their estimates, gross output surged by 10.6%. Now, can you please define gross output and how that differs from GDP, gross domestic product? It's a measure that most of us are more familiar with.
So most of your viewers are familiar with top line and bottom line accounting. The top line is sales. The bottom line is earnings. So you have a top line and a bottom line. And I'm arguing that we need the same in national income accounting. The bottom line is, of course, gross domestic product, GDP. Everybody's familiar with that. But what they don't realize is that it does not count all of what's going on in the economy. It only measures spending at the final stages of production. It's what consumers are buying, business and government. But it does not include the supply chain. It leaves out all the B2B spending in the supply chain, which can be significant. It's even bigger than GDP itself. And so we have this new statistic that the government, the federal government, the U.S. government is measuring called gross output, GO, and it is a top line. It measures total spending throughout the economy at all stages of production. So it includes the goods in process, in production and wholesale, and resource stage. And it's considerable. It amounted to $46 trillion in 2020. Compared to GDP, which was around 21 trillion. So it's more than double GDP because it includes all the stages of production. And when you look at it, it's particularly the supply chain, what you discover for the fourth quarter that was just released is that it is growing substantially faster. The supply chain is growing substantially faster than final output or consumption by the final users. And that's a very positive sign. That's a sign that the producers in the economy along the supply chain are actually making decisions suggesting that consumption is going to increase. And it's a very good leading indicator. And it indicates that the next quarter GDP is going to be rather substantial. And a lot of economists think that first quarter GDP is going to be positive, and GO reinforces that.
So fourth quarter GDP expanded by 6%, GO surged by 10%. Let's talk about the components which contributed to the surge. Now, as you know, government spending is one of the components of GDP. So I wonder how much of this growth was simply just the government spending a lot of money. It's not actually an indication of a recovery in economic terms for the people, now is it?
So you have to look at B2B spending, which is not government spending. Yes, government spending contributed to higher GDP and higher GO, no question about that. And you need to break it down and look at consumption. Consumption made a big comeback, but B2B spending, the business spending at the supply levels, that's where the growth really occurred, and it was at double digits amounts. And that suggests the supply chains are really building up. They're expecting more consumption down the road. And so that's a very positive factor. Government spending is always going to increase because we live in an era of Keynesian economics. Whenever there's any kind of problems in the economy, we run deficits, we adopt easy money. The Federal Reserve is extremely easy with their low interest rate policy. So you have to kind of exclude that, because what you really want to look at is what business is doing, because business drives the economy. Consumption is the effect, not the cause of prosperity. And a lot of readers misunderstand that concept. You really the big elephant in the room is business. What is business doing? Because they're the ones who create jobs. They're the ones who pay the taxes. They're the ones that allow government to do what they do.
Okay, Mark, so let's talk about the Skousen Business Index, B2B Index. Now, let's take a look at this chart. The blue line represents business spending in trillions of dollars in transactions. First of all, why is it that the blue line has been ticking up faster than the red line, which is consumer spending? And the second part of the question is, do you think this will actually contribute to an improvement in the unemployment rate?
So let me just first say that one of the most important things in this chart demonstrates that business spending is substantially larger than consumer spending.
Yeah.
You frequently hear the statement, consumer spending drives the economy because it's 70% of GDP. Well, that's true. It is only about 31% of total spending in the economy as measured by gross output. So business spending is the big elephant in the room, and it's much more volatile. During recessions, most of the time it's declining at a faster rate because businesses relying on inventories rather than new production. And then in the economic recovery stage, which we're in right now, it tends to grow faster. And that's what the chart shows, that B2B spending is growing much faster than consumer spending. And that's an indication that down the road, most businesses think that consumers will consume more, but it's in the future, not the present. So B2B spending is a leading indicator. And yes, it means that they're going to employ more people, that they're going to hire more people. The unemployment rate should continue to decline. And that's a significant development. And it suggests that the government does not need to engage in its excessive big spending programs that are running these deficits through the roof and is causing interest rates to finally rise. And that can cut off this recovery. And the stock market is reflecting that, especially technology stocks, which has been leading this economic recovery, is definitely in a correction phase due to sharply higher interest rates.
Let's talk about the specific sectors of the economy that are likely to grow the quickest. Now, Mark, you've commented on this in your report: agriculture, manufacturing and durable goods, finance, insurance, and real estate is the largest segment of the economy, you wrote. So how do these sectors compare to each other in terms of growth?
Well, one of the things that the BEA does, which is very valuable, is they disaggregate the economy and they look at various sectors. Now, I have been arguing that we have a K-shaped recovery. Biden used this term during the election, and I think that's an accurate one. It's not a V-shaped recovery. It appears to be a V-shaped recovery in terms of the stock market performance and gross output recovering and GDP recovering. But that's because some sectors are growing faster. But there are still major sectors of the economy: the restaurant business, sports, entertainment, the cruises. There's all kinds of companies that are really struggling and threatening bankruptcy. So until those economies recover, until we're opening up completely, then we're still going to have a hit and miss type of economy. And there's going to be a lot of people still applying for unemployment.
Okay, let's talk about the. Actually, before we talk about the Biden infrastructure plan, I want to dig a little deeper. So, why do you think the restaurant and entertainment sector will not recover as quickly? Because shouldn't that be the sector that recovers the quickest? Because they're recovering from basically ground zero. You can't get much worse than that.
No, I agree with you. They should be making a recovery, but the lockdown is still in place in many areas of the country. I mean, they won't allow conventions at all, major conventions in Las Vegas, for example. Orlando, I just went to a conference, the Investment U conference in St. Petersburg, and they limited the room that holds normally 300 or 400 people. They limited it to 95 people to attendance. That can't possibly be profitable for hotels and convention centers and cities like Las Vegas, which are still in lockdown, run by overzealous Democrats. I live here in California, same thing. Governor Newsom is still he's loosening up a little bit, but not enough to get the economy recovering.
Okay. But in investment terms now, Mark, what does this translate in terms of how I should be allocating my money? Which sectors do you think that I should be focusing on that would perform the best?
Well, the technology stocks have gone through a major correction. I think they're going to renew their bull market once we've moved to a new stage of higher interest rates and it's stabilized a little bit. I'm actually quite bullish on the technology sector in general, and certainly healthcare and the new area of infrastructure, if indeed they push through legislation to spend trillions of dollars. It's all deficit money, but still it could encourage the infrastructure sector and agriculture. And this spills over internationally as well. Brazil, China, and so forth. We're going to see stronger economic recovery worldwide with this kind of infrastructure investing, which is much needed. Unfortunately, it may be on the backs of investors if indeed they push through these tax increases.
Yeah.
But that seems to be inevitable. What I'd like to see is a more open economy, if possible, so that we'll have faster economic growth to pay for infrastructure and other expenses.
I've heard this counter argument from several other people that I've talked to, not just one, and they've argued that this year will actually be even worse than last year in terms of economic growth. We're going to get negative economic growth, and one of the reasons is that not all the bankruptcies have happened yet. It's going to take some time before all the businesses that have been staying afloat due to debt, they're going to start to finally roll over this year. So we're going to get a wave of bankruptcies, especially within the small business sector. How would you respond to that?
I agree. I think that's a possibility. Again, it's a K recovery. I mean, you have some companies that are having record profits. The S&P 500, the majority of them beat street estimates. So you have to divide the economy into the sectors that are really struggling and will have to file for bankruptcy, and unemployment claims will increase in those areas, but it'll be offset by more dynamic sectors that do seem to be growing. So the aggregates seem to indicate that you're going to have a positive GDP this year. In real terms, it may not be in the 3 to 4% range. It may be in the 2 to 3% range, but it'll still be positive compared to last year. 2020, it was negative for both gross output and for GDP.
All right, Biden's stimulus plan, $2.2 trillion. Let's talk about the plan first and then how they're going to pay for it. What do you think this infrastructure bill is going to do for the economy? What sectors would it target in terms of growth?
Well, look, anybody who's traveled the world knows that the United States is way behind when it comes to rebuilding its infrastructure. Our roads are in very bad shape compared to Europe, for example. Our airports, they're rebuilding in airports and so on, but it's nowhere near compared to what's going on. Even in third world countries, they have better airports than the United States. There's the bridges. There's all kinds of examples where we need to make changes. However, I actually think it should be done on the state level. Let the states make these decisions. Why is the federal government involved in this project? The states realize what needs to be done. The Federal Reserve or the federal government is in charge of the interstate road system, and that needs to be upgraded. No question about that. And we need to privatize more our airlines and how the airlines are operating. We could learn a lot from Canada in that respect. So I think there's a lot of positives that could be done, but I don't see why is it the federal government has to do this? And besides, as you point out, it's all deficits financed.
One could argue that the states have had their chance and they haven't done much. So now it's finally time for the federal government to bring the hammer down.
Anything is I think the bully pulpit is a great way to do it by encouraging states to perform these functions. And the states are doing a lot. I've been in many parts of the country where you see lots of infrastructure activity on the state level. We just need to encourage it more, perhaps with tax credits and that sort of thing. But for the heavy hand of government to decide where you're going to invest, I mean, that is a recipe for fraud and overspending and wasteful spending and bridges to nowhere. So I'm very concerned about that kind of thing.
Secretary of the Treasury Janet Yellen has said in her testimony last week that she sees long-term revenue raisers to be a possibility. She wasn't referring specifically to Biden's stimulus or Biden's infrastructure bill. She was referring to just stimulus at large. But anyway, the government has indicated they might raise taxes. So suppose they do raise taxes. First of all, how likely is this actually going to happen, that they're going to raise taxes to finance this? And second, what's that going to do to consumer spending? Because you and I just talked about consumer spending being in recovery mode. Is that going to dampen it?
I don't think it's going to change consumer spending that much. It's business spending that's a big factor here. And they are talking about raising the corporate tax rate, which is a mistake. It's a mistake to increase taxes on investment and to hurt people who save money. And people save money more than poor and middle class people. So we are definitely hurting the people who are providing the capital that can be loaned out and invested in infrastructure. So I'm not a big fan of making the tax system more progressive. There's also the concern that they're going to eliminate the long-term capital gains tax break. That is one of on the Biden agenda. That can really hurt stock market performance. A lot of investors will move their assets elsewhere to take advantage of that. May even reignite the gold market, which is moribund right now. Who knows?
Well, where would they go? They're going to move the markets out of the country to go where, Mark?
No, it's not necessarily that they're doing that. It's just that they're not going to sell assets. When you raise the long-term capital gains rate, you do have a problem where investors can postpone the selling of assets. So it's going to hurt liquidity. We've seen this over and over again. People postpone the selling of real estate, selling of stocks and so on, waiting for the rate to go back down to a more reasonable level. But if they eliminate the long-term capital gains tax rate, that's confiscatory. That means the government is getting sometimes up to 50% of the profits. There's no way that government can justify. I teach at Chapman University theory of the cardinal principles of taxation, and there's no justification for government to be receiving, to be a partner where they're getting 50% of the profits, because they're not taking the risk. You and I are as investors.
Mm-hmm. Yeah, very good point. All right, let's follow up another time on just tax theory and acceptable tax policy, shall we say, for our country. Now let's talk about finally FreedomFest. You are the organizer of FreedomFest. Tell us what it is, what's going on this year, and what people can expect.
So FreedomFest is an intellectual feast, and we hold it annually in July in Las Vegas. But with Las Vegas shut down, we decided to move to South Dakota at the foot of Mount Rushmore. A lot of people have never been to Mount Rushmore, and we're getting a huge response. We have over 1,500 people who have already signed up. It's really going to be a great gathering of great authors, professors. FreedomFest.com is the website. It really is an exciting event. I know Kiko will be there as well as other media. It's really going to be fun. And of course, Governor Kristi Noem is going to be there to greet us and do the speaking engagements and so forth. So it's really going to be a fun event. I'm hoping people can join us for this celebration of liberty, where we learn from each other, we socialize, we celebrate liberty, or what's left of it.
I know. Donald Trump was there one year, right? What other? Can you give us a teaser on who we can expect this year?
Well, we have a number of really great speakers. We have John Mackey, the CEO of Whole Foods Markets, who's coming. We have Steve Moore, formerly of the Wall Street Journal with the Heritage Foundation, John Funn from National Review. We have Hershey Ali, who is a former Muslim who's written some very critical books and requires 2 bodyguards. So that's going to be fun. We have people from Reason, from Cato, from all the free market think tanks and freedom organizations. Mm-hmm. So it's really going to be kind of a love fest, but it's also an intellectual feast because we have lots of debates. Our mock trial, which we hold every year, is going to be on the pandemic. Did it justify the lockdown? We have lots of debates, and this will be one of them that I think people will really enjoy.
Perfect. All right. Well, Mark, thank you for that information and for your update on the economy. I appreciate it. Thank you for coming on.
My pleasure, David. Thank you.
Thank you for watching Kitco News. I'm David Lynn. Stay tuned for more.